They didn't invent any new technology. They just don't have this. And they're like, I don't know. They're poor. You know, we're not.
I think there's a lot of people that still just have this old school ideology that like for some reason is valuable for you to put your money in a box and like print more tokens and then therefore you get more money.
Right. If you had like a Tesla perp that you can go 20x long and it trades 24/7, that is actually a huge unlock.
I think that people genuinely like just don't understand the economics of proof of stake to like a meaningful extent.
Yeah, these people could have gone and opened a Coinbase account and bought Bitcoin, but they didn't.
Not a dividend.
It's a tale of two clans.
Now, your losses are on someone else's balance sheet.
Generally speaking, airdrops are kind of pointless anyways.
Unnamed trading firms who are very involved.
Pollock.eth is the ultimate Ponzi.
DeFi protocols are the antidote to this problem.
Hello, everybody. Welcome to the Chopping Block. Every couple of weeks, the four of us get together and give the industry insider's perspective on the crypto topics of the day. So quick intros. First, we got Tom, the DeFi maven and master of memes.
Hello, everyone.
Joining us, we've got some special guests. First, John Charbonneau, protocol provocateur at DBA.
How's it going?
In your mind, you will never not be the L2 nihilist.
Great.
I wanted to try to work that in, but it didn't quite alliterate. And Ryan Watkins, token tactician at Syncrecy Capital.
Token tactician. There we go.
Yeah, good to have you. And I'm Steve, the head hype man at Dragonfly. We're early stage investors in crypto, but I want to caveat that nothing we say here is investment advice, legal advice, or even life advice. Please see choppingblock.xyz for more disclosures. So it turns out everybody is in France, which I keep arguing is a failed state, and I think people should stop going there. But they're in France. Why did you guys decide not to go? Seems like where all the action's happening now.
Everyone's here.
Everyone's here?
Yeah.
Yeah. I mean, we were talking about it. Like I'm pretty much have stopped traveling in the past year for conferences anymore.
Completely.
Yeah.
So you've let them come to you.
Yeah. I mean, if you live in New York at this point, it is just difficult for me to justify going to a conference when this feels like the exact same thing that I did last year of like everyone was just here for permissionless. Like, why do I need to fly to France to go see everyone?
Right.
I remember I did the same thing last year. Was the last one I went to was DevCon in Thailand because it's like, I want to see a bunch of ETH people that I hadn't seen in a while. And then I came home like 2 weeks later and then, like all the ETH people were here for like Columbia Crypto Week. And I was like, why did I just fly to Thailand for this thing?
Right.
That's where I'm at. New York privilege.
Yeah, I agree. I think I've never been a big conference guy, but I think especially post-election, now that people host more conferences in New York, there's almost not really an incentive to leave because it's usually the same people are going to all the conferences.
Do you agree with this?
Yeah, agreed.
You agree?
I'm not there.
Like,
Yeah,
you travel.
not that much.
Okay.
I cut down.
You're asking 3 New Yorkers, right?
Yeah,
Yeah,
no, it's
yeah.
true. It's true. New York privilege, I guess.
Yeah, everyone comes to New York. There you go.
Yeah. No, it used to be that New Yorkers had to travel because New York was like this wasteland with like the bit license. There was nothing going on here. And now you guys are eating nice.
Yeah.
That's good. No, New York is nice. I am surprised how many people went on the same flight to France because they were literally all here and they all went to France. But of course, one of the big things that happened at Cannes, so the ECC is happening at Cannes, and it was well known in advance, telegraphed that there was going to be a big Robinhood event at Cannes. We finally got the announcement. There was a lot of leaks beforehand that maybe this was going to happen, but it came out that finally Robinhood is launching their own chain called Robinhood Chain, very creatively named. And Robinhood Chain, there's a bunch of stuff that they announced in concert with it. The first thing that they're going live with Perps. So Coinbase also recently announced that they're doing Perps, although their Perps are
Perp-style
weird
futures.
Perps. Yeah, Perp-style futures. We'll talk about that in a little bit. But Robinhood, what they announced is, so first, they're doing Perps. I think they're also launching in Europe. Then they're doing tokenized US stocks on their own blockchain, which is Robinhood Chain, which is an Arbitrum-based chain. Originally, it's on Arbitrum mainnet, and then they're migrating eventually to their own Orbit chain, which is Arbitrum's launch your own chain product. Initially, the way it's going to work is that they're going to have tokenized stocks, a lot of the stocks that you already know and love, but eventually they're also going to add SpaceX and OpenAI as pre-IPO stocks that you can trade, which I guess they have some broker who custodies it and securitizes it, tokenize it.
It's kind of dodgy. Like I was trying to read the documentation as to why this was happening. First of all, there's like very little liquidity. I think it's like 500K of each. Yeah, to start. So
period? Like total?
To start. Yeah, but I mean, very little. And they actually market it or it's listed as like a derivatives contract. So it's more like a CFD actually versus or like a swap or like a forward versus being like an actual tokenized version, which kind of makes sense, right? Otherwise, like how would you actually do like redemptions for this product? So yeah, it's a little wonky, I guess.
Yeah, I assume they just like bought a chunk, like they were in the round, and then
they do. So they don't. There's no right to redeem. So it's not guaranteed you can actually like redeem. And so there's
Yeah.
like some general exposure to the price of these assets, but it's a derivative contract that you're buying.
It's a derivative. Okay, interesting. Well, if it's a derivative, why would you have a 500K limit?
I don't know. That's just what they're starting out with. That's what it's listed as.
Okay, interesting. So we've got these two pre-IPO stocks. You've got a bunch of tokenized stocks, and they're also going to be doing. So right now it's like 24/5 that you can trade these tokenized stocks. They're eventually going to move to 24/7, where basically during market hours you route it to a traditional exchange on the back end, but you don't know that. You're a Robinhood user. But eventually on off hours, like on weekends, they'll route it to Bitstamp, and Bitstamp will fill the liquidity when the normal exchanges are not able to fill the liquidity. And then finally, in their phase 3 of this project, they're going to move where you can actually take your assets off of Robinhood directly onto Robinhood Chain and go do DeFi stuff with your tokenized securities or tokenized stocks or whatever. So that's what they're doing. On the back of this, Arbitrum mooned. People got very excited about this of like, oh, this is good for Ethereum. This is good for Arbitrum. This is bad for Solana. People were speculating this might happen on Solana. Didn't happen apparently. Supposedly, I've heard that there was a bidding war over this deal. Robinhood, like people might hear that and say like, oh, how much did Arbitrum get paid? It's like, no. Arbitrum did not. Arbitrum did not get paid for this. They paid a lot of money. Everyone was bidding huge amounts of money to try to win this deal. Congrats to Arbitrum, I guess, on winning it because obviously the market's rewarding them. But it's an interesting moment seeing Robinhood partner in such a big way with Arbitrum as opposed to go their own or completely forego associating themselves with anybody in crypto. What were your guys' thoughts? I guess especially being on the liquid market side. Ryan, what was your take?
Yeah, so I think there's been this big debate on what is like the right way to get exposure to all these secular trends in the crypto economy. Is it just tokens or is it now equity? And Robinhood now is very much building towards this super app vision that I think many people in our asset class really got excited about. Like the idea that within one click through a single interface, you can access all these financial services in the world. But what we're seeing is that there's actually so many different ways to express the thesis. So, Robinhood already has, trading, banking. I mean, they have like retirement products now. I mean, they're literally doing everything. And now they're, really moving into crypto, like really in a big way. It's no longer just you can buy, Bitcoin, Dogecoin on Robinhood. They're now going as far as to like do tokenization, some stuff with stable coins, building their own blockchain. But I think that the question I have with the Robinhood announcement is there's still a lot of details that we don't know, not just architecturally how it works and like the performance you'll get from it and what you can actually do with the chain, but actually how it will integrate into the broader Robinhood product suite. Because it's not enough to just say you have the distribution and that's a reason why this new chain is going to win. Because as we see with Coinbase and Base, Coinbase and Base are more or less like disconnected products. Like you can't access Base through the Coinbase interface. So all they're doing is providing like branding and of course like investing in the ecosystem, developing tooling. But I think you don't really get the magic to happen until you actually have like a deeper integration and you can actually trade some of these tokenized stocks through the Robinhood interface. So that's probably the biggest thing that I'm thinking through now is,
well, so I think
does it matter?
My understanding is that everything for the phase 1 and phase 2 is entirely through the Robinhood app. You will not know that anything's happening on Arbitrum. Arbitrum just has like a registry that these stocks are there and they're being minted and redeemed from the underlying brokers. Only at phase 3 is any Robinhood user going to care that there's even a blockchain because you can't access the blockchain, you can't touch the blockchain. So my understanding is that like probably on chain, it will just look like Robinhood is the owner of all of these tokenized stocks. And it might be sending messages to like, hey, mint and redeem. I'm speculating. There in the presentation, Vlad was like using a chalkboard and like drawing some boxes and stuff. So I'm going off of that. Obviously we don't have any details yet, but from a user's perspective, like this feels very different than Base, where Base very clearly the idea is you go direct to chain and the chain has a relationship with you. In this case, I don't know anybody is going to interact with Robinhood chain for, who knows, maybe a year until they actually decide, hey, we're going to expose this. They did have a call for developers to say, hey, developers, if you want to come build on Robinhood chain, hit us up. But my assumption is that that's a long putt right now. It's like, building on Google Glass or something. It's like, look, well, someday maybe this will be worthwhile, but we're not making any promises about when this is going to actually be commercially relevant.
Yeah. Well, I think if they have like tighter integration, that's definitely directionally what you want to see. So you can actually build towards this super app vision.
I will say I kind of hate the term super app. I don't know how you guys feel about it, but like it's been so many years that people keep using the same term, and I'm kind of like, a super app is I don't know why I hate it so much. I feel like it's a description of, okay, we have a bunch of products that all work and people live in your app, right? But it's like, it's not a strategy. It's more like an end result of like you crushing in a bunch of different domains. Like what happened in China with like China having a giant super app is very path dependent. I don't think anybody has a super, like Google doesn't have a super app. I use a bunch of different Google apps, but there's no Google super app, and I wouldn't use one if they had one.
Agree. I think the sequencing definitely matters. I mean, this is even something, this even relates to me even more broadly, a little bit of tangent, just like the broader story of like smart contract platforms, where in a way you can almost say that these are like positioning themselves to be these like global platforms or super apps where there's all these applications that you can access on this one single substrate. But in reality, I think what we've seen is that throughout history, the most change with the exception of Ethereum have started with a specific product and only then have started to go horizontal from there. Right. So even think about, Bitcoin. Bitcoin is the product. It's quite simple. You think about Binance Smart Chain or Base or even Hyperliquid or to an extent even Solana. I mean, in many cases, either the chain started off being application specific or had like a clear end goal of like, I want to build decentralized NASDAQ or I want to build an exchange, or it was like an off-chain exchange that already was the product that is now going general purpose by directing people to that platform. Right. So I agree with you. I think it is like a loaded term, and you can't, and we've also seen so many people try to do this throughout history. Like in DeFi, we had SushiSwap that, they were like the number 2, 3 AMM on on Ethereum. And then all of a sudden they're like, all right, we're going to do lending and derivatives. And it's like, dude, you guys haven't even figured out what your core product is. So I think the sequencing definitely matters.
Okay. Speaking of sequencing, give me the L2 nihilist take on Robinhood Chain.
So the way that it is right now, I want to see, I'm curious where we're going to end up in, call it 2-3 years from now. If we look back and we say, was it the right move to do their own L2 versus just like throw this on some other chain? Particularly in the starting stages, I don't think it is, where this is like a very seemingly back-end abstracted away from most of the users, and like they're just kind of controlling what's going on in the back end. The more that people start to interact with the chain, and they're able to possibly like curate an experience and monetize it a lot, I think that you start to get more of the value possibly of owning the whole stack yourself, of whether that's just monetizing it more through sequencer fees or being able to control it in some way. I want to see where they take it in the product direction in general, because the main difference that it seems like with Base and Robinhood is I do think that they're like taking a pretty reasonably meaningful different approach and like what they intend this thing to be. In that clearly Base is pushing very aggressively in this. They really care about the crypto native kind of like application sphere and going very general purpose and integrating, social apps. Like, I mean, Jesse is obviously like the coin it and everything. Like they're trying to integrate like Zora and all like Farcaster and everything like really into the Coinbase app and getting this much more crypto native, like very on chain, like Jesse's out there, like getting everyone on, bring all the general purpose app developers to us. Versus Robinhood is like very clearly not doing that. Like when they talk about this, they're very clear that this is an RWA chain. Like we're not interested in, getting a bunch of people who are deploying these, net new crypto native types of assets, getting a bunch of those types of application developers and use cases. It's like, you're going to come here, you're going to trade equities, like you're going to do this through our app. And like, this is what this is for. We're not interested in social. We're not interested in like most of this Web3 kind of stuff. And so I think they're going to end up looking like actually pretty different and clearly where they go. And it's really just going to be driving like what are the core products that they're shipping through the Robinhood app and just integrating this into the back end for them.
Yeah. Interesting. Tom, do you agree with this take?
Yeah, I mean, I think it's still very early in like the corp chain playbook, and no one's really figured it out. I actually like BSC is like probably like the most successful of these in terms of like value accrual and then also just like overall traction. But there's nothing really people can sort of copy paste and use for their own purposes, which I think is how this stuff actually takes off is, hey, here's the playbook that we run. And there's not really any glowing examples of success. Like this could honestly end up like the corporate NFT marketplace boom, if you guys remember that. Or this could be like the next, Sonium, where it's like, I don't even know what's going on Sonium. So I didn't mean to disparage Sonium, but it doesn't seem like anything's going on.
The Sonium team is going to write us.
Yeah. It's,
how dare you?
I think, people maybe underestimate like the, exploratory experimental budget for a lot of these companies. Like, yeah, they'll try something. If it's not super expensive, that doesn't mean it's like a full commitment or a full sort of strategy pivot. Also, the Bitstamp thing was weird. Bitstamp doesn't have perp, or didn't have perp before the acquisition. So I don't know how they're like using Bitstamp then to like.
No, because these are not perps. These are spot tokenized stocks, right?
But they're also
but they're tokens.
right. But they're also saying they're going to use Bitstamp to offer their Perps product. Which I also didn't quite understand unless they're building it. Yeah,
probably. I don't know. Yeah, it's interesting. It's an interesting take. Like my there's this broader trend right now that a lot of people are talking about stock tokenization. There was this other project called X Stocks, which recently announced that they are taking their tokenized stocks, similar like top 50 stocks, and they're partnering with Bybit, Camino, like a bunch of different apps to offer their stocks on all these different platforms. People are very animated by this. And that being said, X Stocks is a platform. Right now, I believe their total TVL is like less than 10 million that in total issuance of these stocks. So I'm really curious what you guys think about this tokenizing stocks meta, because it's been around for a very long time. I remember in 2018, 2019, people were trying to tokenize stocks again in 2021. Obviously, FTX did this very famously, was tokenizing stocks for trading on their platform. A lot of people have done this and tried this. It's never worked. Never really had a lot of demand. And yet it's one of these things that people seem deeply convicted on, that obviously it's going to work. And it's just a matter of how, when, angle of attack, something or other. Maybe the wrong customer was on chain and now they're finally here and they actually do want to trade stocks. Like, what is your theory of the case for why stocks on chain has not worked, why it is now poised to work, or are you skeptical that stocks on chain is actually compelling?
Yeah, so I think from I'll break it down from the user perspective, and then maybe from the perspective of someone like Robinhood. So I think for Robinhood, it's just really like John said, it's just back-end infrastructure where all of a sudden now it can possibly capture some fees or even save some margin by getting rid of all this underlying stuff that's in the financial stack, right? And for that, it's not like what is actually the big deal? The big deal is that Robinhood is just going to push some of their flow to either Robinhood Chain or Arbitrum, and that's pretty much it. But for that, you really do need someone that's like someone who owns the users to drive that flow there, because I don't think the users are going to do that themselves. For the users, this has also been the biggest question I've had with this is, what practical value do you get as, let's say one of us buying Tesla on a blockchain? And there really isn't. I think if you are someone who is not in the United States and can't access stuff easily, then it actually makes a little bit more sense. Like you were actually doing something that you couldn't do before. But other than that, I really don't think there is for like these tokenized equities. Now, I think where it does get interesting is when you start to think about the composability of having some of these tokenized assets on chain. So if now all of a sudden it's very easy for you to go in, borrow against that tokenized stock in a way that maybe wasn't as simple on your brokerage platform, then maybe that's an unlock. But even to me, that's still incremental. So I actually one thing that I've started to think about more recently is actually that the way that you'll get users excited about this is when you can do something that you can't do today. So I think perps are a good example, right? If you had like a Tesla perp that you can go 20x long and it trades 24/7, that is actually a huge unlock, right? Because you can't get more than on a single stock from your broker, you can't get more than like 2x leverage. So if all of a sudden you're getting 20x leverage and you can trade it 24/7 and cut risk on the weekends or get long at 7 p.m. on a weekday, that's actually like a big unlock. And I even think that not even just retail users, but even hedge funds would want to use that product because it actually is like a huge advantage.
You agree with this take?
Yeah, I definitely agree with that. Particularly as a US user, that's the same thing that I've always thought of. I don't have a use for this other than if you give me a new product, and fundamentally the unique product would be perps that a lot of people would use. The getting it to overseas users who don't have access currently to US assets is the part that I think is meaningful, where I think already exists to market today. The tough part is these products are quite janky today, where it's the same thing of really this is just a kind of weird derivative looking thing where you can redeem it for the cash value off chain if you're KYC'd after the fact. It's kind of a weird thing. It's not going to have great liquidity. It's just generally a weird setup. I think a lot of the on-chain equity stuff is a more difficult example of why stablecoins were able to flourish early on, where I think a lot of the benefits of on-chain equities mirror in many ways. It was something that I'd heard you talking about on a podcast, where I think it was the one that you did with Joe Weisenthal, where you were talking about stablecoins. And it was a take that I very much agreed with, that I thought of before, of a lot of this, very possibly the reason that stablecoins, that we're going to look back at why they made sense, was probably just a lot of the regulations and laws that we have around like dollars and the way that all the settlement stuff works today, like probably doesn't actually make sense. And the easier way to do this is just kind of rebuild the whole system. I think we probably have a lot of that with equities, where you just say to yourself, I mean, a lot of these problems that with equities that we're talking about, they aren't actually like fixed by crypto in a fundamental sense. Like legacy tech can in theory just support 24/7 trading.
Yeah.
Like legacy tech can in theory just give access to assets to people who are in Europe or whatever country who are like not in the US. There's nothing about legacy tech that stops you from being able to sell a stake in OpenAI. Realistically, I think a lot of it is we're trying to come up with like these new fancy ways to like make on-chain equities and like, okay, how can we use that to kind of push the boundaries of what we're allowed to do in some ways? I think in practice, that's been much harder to do with equities as opposed to digital dollars, where early on, it was a lot easier to be like, all right, we're gonna have like money in a bank account. We're gonna put the dollars on chain and like go do what you want with the dollars.
Yeah.
In practice, that's been, I think, a lot harder to do with equities. And there's a lot more like regulatory barriers that people are clearly pushing up against, where that's why this is sort of like a janky product early on. They're not just, Robinhood isn't saying like, hey, we're just gonna put like Tesla stock on chain and like go do whatever you want with it. Because you'd be breaking some laws.
Yeah. I mean, I like the analogy with stablecoins, because with stablecoins, and I think it's in a way even more severe than with stablecoins. With stablecoins, you can ask, okay, why can't I do this thing with dollars instantaneously and send it on a bank holiday or on a weekend or to somebody quickly? And somebody can explain to you why it works that way. With stocks, what I find is that there's nobody who can explain to you why it works that way. Right? Like, why does it take T+2? Why can't I do this thing at 7 p.m.?
T+1 now.
EST. Oh, wow.
Big upgrade.
Amazing. Okay, yeah. T+1. Why is it all T+1? And nobody can really explain the whole thing to you. They can kind of be like, well, that's just how it works because of this thing. And it's like, well, why that thing? And there's like, well, I asked that guy. And like everybody kind of has this sense that like they're sort of hemmed in by just the regulations and rules and laws and transfer agents and brokers and this thing. And it's just like, well, you can't, we're just stuck. Okay. Sorry. That's just how the system works. And you look at like India and you're like, no, they don't have any of these problems in India. Like this is a totally centralized system in India. They didn't invent any new technology. They just don't have this. And they're like, I don't know. They're poor, we're not. And so we have it this way. So I think there's a path dependence to these things. And I think if your system is broken enough, sometimes you're just like, let's take that technology and use it to solve this problem, just because it's a fig leaf for being able to paper over the fact that we just have a broken system and we need to just start over. And if we could start over with something else, we would do with that too, right? Like there's nothing that stops, like Robinhood phase 1, phase 2, there is nothing in phase 1 or phase 2 that needs a blockchain. All of this could just be basically securitization of just some intermediary that holds stocks on your behalf, and Robinhood trades some entries in a database. It is interesting that maybe once you take these stocks and bring them on chain, you can do stuff with them. And I think I give a little bit more credence to the idea that like, hey, if you think about the asset classes writ large that should be tokenized and brought on chain, okay, dollars first, which we already have, treasury second, growing, they're in the, $5 billion range. RWAs, okay, we've got like 40 billion or something of RWAs, 30 billion, something in that ballpark. Stocks are huge. US stocks in particular are huge, absolutely enormous, very large demand around the world. And it makes sense as you start to bring the people, so the people on chain that, you're sort of pointing like, oh, the people in this room, what the hell are we going to do with Tesla stock on chain? Answer, obviously nothing, because we can already buy Tesla stock. The whole idea is that the other people on chain, okay, but what is some, guy from China who like comes on chain? Is that guy going to buy Tesla stock? Well, no, he came on chain to gamble, right? He came on chain to buy meme coins just like you and I did. He's not on chain to like make sound financial investments. But the idea is that over time, as more and more people who come in through the stablecoin route, as opposed through the crypto casino route, they're coming in to save. They're not coming in to speculate, right? And if more and more of those users come on chain, they are going to want Tesla stock. They are going to want the S&P. They are going to want bonds and all this other stuff that to us is kind of like, well, I already have this. Like, yes, we do already have this. But most places around the world, they don't have this in the same way they don't have dollars, right? Because capital controls otherwise, or just, investment restrictions on these assets. So that's why I think the tokenized stock story makes sense only as stablecoins bring more and more savers into the crypto economy. But that's still a slow going process. I think it's going to take some time. So my guess is going to be that what we see from Robinhood Chain is that Robinhood users are going to use it, and very few other people are going to be using it or using these tokenized stocks. But it's more of a 5-7 year growth story, I think, for these assets. But it's later in the process compared to cash and then, just treasuries and like, really safe investments. That's what do you think? What do you say?
Yeah, I mean, I think the global access thing is very real, and I'm also always kind of reminded of like the fact that people are very mobile, international these days. And so it's like also the idea like you're like married to this one weird brokerage in this one weird place, and then sort of fragmenting like it just doesn't make any sense versus like, oh yeah, you have one account that like lives with you wherever you go. I think also makes more sense. I mean, the big critique right now, and I think also why this has not worked previously, is people have this like, I think kind of very idealistic vision that you're going to get 24/7 trading like overnight, which is like probably not, it's not going to happen right away, right? Like no one's going to be willing to quote at like a random hour on a Sunday or something. But I think it's kind of like stablecoins. You can hit this tipping point where you hit this critical mass, and okay, actually this is not two separate systems. There's not stablecoins and the dollars, and then you get like a USDC DPEG because the systems are not in sync. But eventually this becomes the system, and there is no DPEG because it is the asset. And I don't know where that threshold lands. Maybe it's 10% or 20% or something that makes it robust enough where, hey, this can actually be the system in and of itself. And then I'm surely somebody will show up to quote off hours, right? I kind of think a little bit like Uber in some ways, right? Where, oh, someone could have told you 20 years ago, oh, no, there's no demand for like a taxi, deep in Brooklyn at like, midnight. And like, okay, well, actually, we just build the market infrastructure and let both sides of the market sort of figure out if there is demand and what the price should be. And I guarantee you, if you allow people to quote and trade on midnight on a Saturday, somebody will show up and quote you, and it's like, let's let the market kind of figure it out.
That's a great example. That's a great example. I was listening to an Odd Lots podcast where they were talking about Iran and Iranian markets, and the Iranian stock market, which apparently is like $150 billion market nominally, and the Iranian stock market has been closed for like weeks, right, because of just all the instability going on. And they close on religious holidays, and they close on this and close on that. But obviously, if you're getting bombed, you fucking you close the stock market. And one can imagine they're like, okay, well, so the prices, it's still a $150 billion market because it hasn't opened since the bombing all started. But like, to your point, okay, the idea is like, well, who wants to trade when there's a war going on? And the answer is, of course, anybody who wants to reallocate their money, because the one thing that is still trading is, I don't know what the Iranian currency is, but the local currency for Tether. That pair is still trading. It's trading constantly, 24/7. And it is the only way that you can actually tell what is the price of the Iranian currency at any given time. And so there is this sort of elegance that like, yeah, you might not think there's a market at 3 a.m. Like, who's going to wake up and drive at 3 a.m. and take some guy to the airport? The answer is like, yeah, somebody will. And actually they're willing to pay like a pretty normal fare because some crazy guy's up at 3 a.m. even if you can't imagine who they are. In the same way, there is somebody who wants to trade Iranian currency. Actually, probably a lot of people want to trade Iranian currency and potentially get out of the currency. So I guess switching gears a little bit to talking about perps, because you were mentioning like, okay, I think perps is maybe the big story. Tokenized stocks, yeah, whatever. Maybe that's an interstitial thing, but like perps is the big unlock. So Robinhood obviously announced that they're doing perps. We know that they were coming into the perps game. The U.S. is not fully, the CFTC has not fully cleared anybody to do perps yet, but Coinbase offered this intermediate product, which is a perps-like dated future that expires in 5 years. So it's a 5-year future, which in crypto world is basically forever. So, by the time we have perps, like, this thing is not expiring until you guys are retired. And this 5-year perp, so they have a perp-like funding rate on the asset, but it does have technically an expiry date. And my guess is they're only going to issue one. They're probably not going to issue like, one every month or something. So that's what they have for now until they get true perps. So I want you to elaborate on why you said that, hey, tokenized stocks, whatever, but tokenized perps on stocks, amazing. What is it you think is the big unlock with perps on stocks that's so substantially different?
Yeah, I just think that when you don't need to worry about like the physical delivery of the underlying asset, it just makes it so much easier logistically to get that asset on chain. Because not to oversimplify, but in order to create like a perp, all you really need is like a price feed, right? And then you have people who are willing to take both sides of the market. So it's just a little bit easier to go and represent whatever it is, right? Tesla, Robinhood, whatever you want. So that's one. It's just like easier logistically to get it on chain and actually have it trade in a way that is competitive with what already exists. And then what actually makes it more exciting is, like I said, it a little bit, to an extent, is a little bit of regulatory arbitrage, but the idea that you can just get more leverage on assets than you could in your brokerage account. I mean, that is actually huge. I mean, not to be cynical about the current state of the crypto economy, but so much of the reason why people go to these exchanges or go to a blockchain, which in many cases is just an exchange as well, is just so they can go and speculate, like on meme coins, and it's leverage.
But that being said, Robinhood and Coinbase are both only offering 3x leverage.
Yes. Yeah. So
To start.
to start.
To start. I mean, well, how does that work? You just like be like,
I mean, maybe
let's
they
ramp
still
it
want their
up, or-
customers to lose all their money. So
Yeah.
the 3x. No, but I mean, it's just a incremental step. I mean, I'm sure they'll offer more once they can or once they get them. But yeah, I think just directionally this is where it's going.
You think okay, how high do you think leverage in the US is going to be for regulated perps?
Oh, I have no idea.
I mean, you can't get much leverage as a retail trader anywhere that's
Yeah.
regulated, right? So I can't imagine it would go that high.
No, I think with the DTC caps at like 4x or something like that right now for
Is that right?
Yeah, it's like the sort of haircut that you apply to like different assets. So it's like not, I guess this would be for like futes, but same kind of thing.
Right.
I don't know. I mean, I think there's also like this like again Reg R kind of story for perps where hey, maybe you actually have it offshore, or maybe you are sort of offering people access to like a perp deck somewhere. So you're not the one actually building the product, but you have like an interface. And I mean, there's a thing people are talking about was like the Robinhood fees are kind of crazy. But I think that's kind of what the market's willing
I
to
saw
support.
that there were no fees.
But no, there's fees.
They have fees?
Oh yeah,
I thought the whole idea was that they just charge a
I
spread.
think it's 10 bips.
Yeah.
That's
for the
top
for the
tier.
highest
Yeah,
tier.
yeah.
If
If you're trading less than 50K, it's like 80 bips or something like that.
80 bips.
Yeah.
Wow. Okay. Interesting. I didn't realize this.
Yeah, I mean, so this is why we've kind of ended up with, I mean, like, I feel like most of the conversation around Hyperliquid realistically over the past few months has been like, all right, this is great, but, Coinbase and Robinhood are going to show up, and then they're going to have perps, and then, like, a lot of their customers are going to leave. And then, I mean, the current state of it is like, all right, Robinhood's going to offer it, but it's going to be 3x max, and it's only going to be in Europe. It's not going to be in the US. And then Coinbase is going to do this like weird longer dated product, which is also going to be more expensive. We'll see how liquid it is. We'll see how well it trades. And realistically, I mean, again, this is nothing fundamental about crypto versus like centralized infrastructure. It's just you're sort of not allowed to do that right now.
Right.
And so there's the arbitrage to go do that and provide that to consumers, because consumers obviously want that.
Well, what is the average leverage that somebody actually takes, right? So people, like, there's obviously some people who are crazy and take 40x leverage. My understanding is that most people are below 10, right?
Yeah. I think it's quite low. I think it is like on the order of 3 or 4.
Yeah. So most people are not doing, like, so, the marginal user is going to be like, well, 3x leverage, fine, that's all I do anyway. The crazy, like the James Wins of the world, okay, they obviously they're gonna stay in the fast lane.
Yeah.
So I agree with the story directionally. Is that like obviously okay, a Hyperliquid or some kind of DEX is going to play faster, going to play looser, is going to offer more products, and is going to it's the deep end of the pool for those of you who like have too much brain damage to manage the just pure Coinbase kiddie pool. But that does sound like that's probably still a lot of users that would get siphoned away, right? I don't think it's wrong, even if it's not complete.
I don't know how many are going to get siphoned away off of what we're saying is just clearly like a worse product. I think it is sufficient enough that you will onboard net new users. I don't know anyone who is using Hyperliquid right now who is going to look at the Coinbase product and be like, oh yeah, I'm going to stop using Hyperliquid and go use that. Like it's still just worse, and it like actually takes you like some effort to go switch to the thing. I think it's good enough to get net new users. Like I am sure that there are people in Europe who just are normies who don't really go on chain a lot, and they're like, cool, I can do 3x leverage on Bitcoin. Like this is fun.
Yeah.
My guess is it's more of that as opposed to picking off the current market of people who are like, I want to be on chain. I'm comfortable with doing that. I want high leverage. I want new asset listings right away.
Yeah.
I'm guessing you're just not going to pick off a lot of those consumers right now.
Yeah.
Yeah. I think also the product is just still, like you said, it's very limited. So the idea that I'm trading on Hyperliquid and I want to go pay 10 to 80 bips per trade, and I can only trade just like a couple assets, and I can only get 3x leverage, and I can't even access it unless I'm in a certain country. It doesn't really make that much sense. And I think it'll make even less sense as you start to, I think, maybe get an acceleration of new perps markets being created on Hyperliquid once you have like the HIP-3 that comes out. And then people can access it through different interfaces. There may be prediction markets, or maybe, equity perps as we suggested. And then that is just like at that point, it's just a totally different product than what Coinbase or Robinhood is offering.
So I hear you on that front. And again, I think I don't know what the marginal user of Hyperliquid is even like, right? So obviously everybody in this room is on this podcast is a big boy, and so you guys are trading size. You guys are more sophisticated. The marginal DEX user is obviously taking a bunch of leverage, has no inside information, is just kind of punting one way or another. And I have to imagine at some point, like something. So perps being regulated in the US, is going to take a little bit of sting out of the perception of perps, right? Because I actually think the Coinbase 5-year thing is a good idea. Obviously, it was cute and people were dunking on them, but I think it's actually a good idea because 5 years, like, obviously perps are either going to get approved or banned in 5 years. So one way or another, you can move off of this product to like the main thing, and then you're fine. 5 years is like as long as Solana has existed. So it's quite a long time before we have to worry about the expiry of the one Coinbase perp or future like perp like future. But it does seem like the growth story for DEXs does get eaten into, given the fact that there are a lot of people who are using a DEX, but they are probably like, I don't know if I can trust this. I still remember FTX, the Mango markets, like, they've been around the block and they know that, like, look, this is the best product, but Coinbase, like, if I lose money, I don't know that Hyperliquid is going to come in and like make me whole. I know Coinbase will make me whole. This is a $60 billion company, and Hyperliquid, as much as I love them, like, it's the Wild West out there. How many people are there like that? I don't know. Are there some people like that? Almost certainly, given that, like, I know enough people who've been wiped out in DeFi or have gotten rug pulled or whatever, that kind of stuff happens. So if I had to guess, I think Hyperliquid is likely to still grow, or the on-chain perps market is likely to still grow, in some part maybe galvanized by the increased understanding of perps. And like some people who onboard through Coinbase will likely go to Hyperliquid and say, oh, I got perp pilled. I was trading spot. Perps are way more fun, but I actually want to go more than 3x. Where can I do that? Or I go on Reddit or I go on Twitter. Oh, there's this thing called Hyperliquid. I should go figure out how to get there. And then at the same time, there are probably some people in Hyperliquid who are like, I really just want to trade perps in the US. I'm only using 3x leverage. I'm a little worried about all this on-chain DeFi stuff. I might go to Coinbase. So I can see actually both growing at the sime time.
Yeah, I think it's a really good point. I think it's easy for us to get caught up in just the competitive dynamics. We're looking at this stuff every day. But I think for like a normal person, I just go back to the Solana example where, once again, if your mental model of Solana is that it's basically an exchange, like, why was it able to actually get volumes? And were those like net new volumes, or was it volumes that were stolen from the central exchanges? Because, we saw, at the peak in February, DEX volumes reached like 25-30% of centralized exchange volumes. And that was largely just because of the Trump meme coin. And what is the reason why I think I was able to get those volumes? Well, it's because it's offering, one, it's anyone in the world can access it, right? And then two, you can access assets that just aren't available on the centralized exchanges. Right. So those are volumes that those exchanges would never get. And these are just like net new people coming into the asset class to go and buy those assets. And I think it'll work similarly for this as well, where it's like, I think as John said before, people who are going to trade perps on Robinhood, these are probably people who have never touched the crypto economy at all before. Maybe there's people who are just trading Tesla options, and all of a sudden they're like, all right, well, I'm going to try out this new instrument that Robinhood has put up to the front up top of my app. And they go and do that. And they're like, you know what? This is cool, but I don't want to go 3x long Bitcoin. I want to go 50x long Farcoin. And then they go on chain and they go and do that. So I really do think it's probably going to be more, I think the expansionary potential of this outweighs whatever competitive pressures that it might introduce near term.
Yeah, I just tweeted earlier today, like the UX flow for the Robinhood app. Did you guys see this?
Yeah, it was nice.
It's really slick. I'm like, seeing how perps get traded on other platforms, where like you're staring at like there's like 7 different tables in front of you or whatever that you're doing as you're like manually typing in, like, oh, here's my like all of that stuff. It's like just these beautiful sliders up and down. Oh, this is what happens when Silicon Valley touches crypto trading. Like this is just like another level of polish.
Or the Rhone Valley, even.
The Rhone Valley?
It's like, although everyone's like presenting was like European, and it was a very awkward presentation. I don't know if you.
It was.
Yeah.
I thought it was cute. It
was very scripted. I felt
it was, but I don't know how they. I was like, did they memorize all those lines? I thought it was very impressive.
Oh yeah, that's a good point.
Yeah.
But yeah, I think there is like a silent majority in, I don't know, in investing overall that we kind of forget about. Man, look at like the ETF success, where it's like, yeah, these people could have gone and opened a Coinbase account and bought Bitcoin, but they didn't. And they didn't by a very large amount. And I mean, I think the success of the ETFs sort of shows that. And even, Robinhood, well, I think like 30-40% of the revenue is from crypto trading, which is like insane. So there's like a huge body of people out there who don't want to go on Coinbase to go do this thing. They want to they want to be lazy, and they want to be in their own existing, brokerage. And great, now they can go and buy these things. And so it feels like that's the audience that you're kind of tapping into. It's this big, bottom of the iceberg versus like these very like, on-chain crypto people.
Yeah. Well, so, okay, speaking of the ETF, the other big story this week is that on Wednesday, there's an approval for a new ETF for Solana. So this Solana ETF, it's a little bit weird. It's a Rex Osprey Sol ETF, the first US Solana ETF, as well as the first US staked ETF. Now, it's a little bit weird because this ETF is actually a C-Corp. So I didn't totally understand all the details, so I'm going to muddle through it to the best extent I can. I don't know. Do you know more of the details about this? You
No,
don't.
It's not something funky.
Okay. So my understanding is that it's a company and the ETF owns shares in the company. And so when you subscribe in cash and they put the cash into the company and the company goes and buys Sol and stakes it and then redeems, like the redemption is like shares of the company that you can go sell. So it's a little bit complicated, but technically the underlying gives you exposure to staked Sol. And because it's a C Corp and it's not like raw Sol, you don't have to deal with any of the, like it's technically just a company. So that is how they kind of evaded the issues with staking and resolving like, okay, Solana, this or that, or blah, blah, blah. So this thing is going to start trading on Wednesday. And there's obviously been a lot of anticipation about the Solana ETF complex. A little bit weird that like Rex Osprey is the first one to get over the line, but obviously they were very creative in their structuring. So good for them. And despite that, Solana doesn't seem to be reacting. Right? Like the asset was up like 2% yesterday. They're down like 5% today. So it's kind of all over the place. And it seems like maybe we're in a different moment where people no longer believe the ETF story. Maybe the Ethereum ETF, which is largely underperformed expectations, it's like 8 billion total compared to like, what is it, like 100 billion plus for the Bitcoin ETF complex. The sense might just be like, yeah, this is so marginal that it just doesn't really matter. What's your take on the Sol ETF?
Yeah, I'd say two things. I think one, I don't think staking is that big of a deal for ETFs. And let's just go back to the Ethereum example. I remember there's a handful of people were speculating, okay, if Ethereum had staking ETF, there'd be more inflows. It's like, would it really, like, is the person who has a ton of money in their brokerage account, would they really be more interested in buying ETH if they can get 2% more in ETH and ETH is just going to go underperform anyways?
Excuse me, 3%?
3%.
3%, thank you.
I don't think it makes a difference. So I don't think the staking component matters that much. I mean, of course, it's obviously like a better product if you have staking, so you're not getting diluted, but I don't think it's actually going to incrementally drive like a ton of more flows. The second point is, while I do think the ETFs are still important, I don't know if they're as important as they were before we had all these treasury companies spin up. Because now you can get, I mean, once again, it's not.
Hold on, but none of the treasury
perfect.
companies are live yet, so you can't like. There's no alternative right now to buying Sol. On
Yes and no. I mean, you can
account.
buy like DeFi Development Corp and all the like.
Isn't that Canadian?
Yeah, but they trade at like huge premiums to NAV. So like they're not perfect, but you can get some exposure to Sol in public markets if you want to, right? So I don't think it's like as big of an unlock as like there was no way to get exposure and now you can get exposure. And then like I think maybe what you said as well, maybe people do have a little bit of PTSD from the Ethereum ETF because there's so much anticipation leading up to that. Like, oh wow, look at Bitcoin. Everyone thought that this wasn't getting any flows when it came out, and all of a sudden, it just rocketed, and it was like the most successful ETF launch ever. And then ETH comes out, and there's just no interest.
Yeah.
Right. So why would there be interest in Sol if there's no interest in ETH? Right. It's kind of like the way that people are thinking, especially now too, when I think this is something just more generally that Solana to figure out. What is kind of that next big story for it beyond own the casino?
Yeah.
Right. Because that is, I think, very clearly behind us at this point.
I mean, if Solana ETF launched last year, it would have been insane. It would have been totally meteoric.
It would have been a monster launch. Yeah.
Exactly. But now it feels like you've kind of a little bit missed the window, which is sort of always the regulatory story, is that the approval comes a little bit too late for the party. It's kind of like, Gensler going after OpenSea like 2 years after NFTs collapsed.
Yeah.
That's just
I guess Kalshi got approved, like a month before the election or something like that?
Yeah.
Tough.
True. But the staking yield point is an interesting one because so I was recording some clip by the roll up talking about staking yields, and it blew up, and a lot of people got really it really animated a lot of people about the question of whether proof of stake, nominal yields, and this idea that these blockchains are basically paying too much yield because the security models are a little bit overstated or a little bit fake compared to what we originally imagined they were going to be when everyone was writing their white papers and their inflation curves in 2019. That in the world of professional stakers, where it's the same 12 guys, and I got blasted for saying it's 12 guys, where the same 12 guys are validators on all these chains, like you're basically, it's not the security model. Like if you had gone and rewritten these papers, and you wrote the assumption of, well, there's 12 guys and they're all professionals and they all like are basically the best service providers, you would have come up with a very different model for how proof of stake ought to be distributing emissions. Curious for your guys' take on this story, because I think it ties very much this, is there really demand for staking thing?
Yeah, I mean, I strongly agree with it. I think this is kind of like the top of the market in many ways for proof of stake, or well, I would say we're past the top of the market of like sentiment of, you know, economic security is this wildly important thing, and we're gonna have all these big staking companies around it.
So to be clear, when you say proof of stake, do you mean like, because some people were interpreting that as like, oh, proof of stake coins are cooked.
Yeah. The mechanism and the importance of it, where, oh, you know, economic security is this super important thing. And like, this is how we can compare these chains. Like, people are going to go to Ethereum because it's the World War III, you know, resistant security, because it's got way more dollars staked, and we need to pay for a certain amount of security. I think most people just realize at this point, like, this is just not how it works in the real world. I mean, like, it ties into, I mean, it was the post that I had written, I think like 2 years ago at this point, on like proof of governance, where it was basically just calling this out straight up, where it was like, hey, I don't think this like actually makes any sense for like the vast majority of chains. Like, if you just play this out, I mean, like, literally all the funds are delegated to people. Like, so, I mean, you just have that obvious inherent principal agent problem. So like, it's literally not anyone's money that's being staked, which is why, I mean, people have toyed around with like, should we just get rid of slashing on a bunch of these chains? Like, it doesn't actually make sense to slash someone when like the person
Solana doesn't even have slashing.
Exactly. And I mean, that's part of why there isn't really an urgency for chains like that to have that. I mean, there have been serious proposals in Ethereum over the past year or two, like, should we get rid of slashing? Should we minimize slashing? Should we like segment it to certain portions of stake? There were serious conversations around like having these kind of like dual tiered staking models, because it was realizing this, like, hey, pretty much all the funds are delegated, and there's like a handful of people who are doing this mostly.
Yeah. So okay, how does it really work then? Explain to us like the proof of governance concept. How does Ethereum, let's say, which people think of as like, okay, Ethereum's the most robust, the most secure. If I want to issue a bond or something, I should do it on Ethereum. How is Ethereum actually governed?
So Ethereum, I would say, is unique from the other chains. If you have a really strong design goal constraint on, you actually really want to let anyone join your validator set, like you care about that validator number 1000 who has like 32 ETH and he's providing effectively no stake to the network, but like a little bit, and you don't want to have any opinionated governance that's like literally just picking the validators, then you need proof of stake as just like, this is the way that you just let the market pick who the stakers are going to be. It's like the easiest way to do that. Versus if you have an opinionated chain, which is how like any Cosmos chain works, or Hyperliquid, or any of these, where it's like, all right, we have like 100 or less validators. In practice, most of it is the top like 20 or so. Like, we can literally point to them and handpick them. Like, hey, we want P2P to be one, we want Figment to be one, and then you can just have a direct economic relationship with them, and you can kind of bypass this idea of like, hey, why do we have 8% inflation, where most of this goes back to the staker, and then like the validator who's like actually providing the real security is getting this like little bit of a sliver of a commission off of there. Why don't we just pay them if we agree that that's actually where the security is coming from, and not from all of the dollars staked by that other people? Because what you're doing is, I mean, it's just tax inefficient at that point, and which is why there's a big push on a lot of these networks. Like, hey, why do we need this high inflation rate? You know, if I'm getting 10% in staking rewards, but I'm being 10% inflated, I'm just paying taxes on like what I hold every year. Like, this doesn't make any sense.
Right.
You know, why don't we just take that 1% or whatever we need and just pay it directly to the operators that, you know, we handpick? And so I think in practice, what we're seeing a move towards that, where there's more openness towards these kind of like POA style chains. Like, no one actually cared that Hyperliquid realistically in the beginning was like a handful of people. Even now, I mean, it's 16 validators, I think.
Oh, people care.
Okay,
people definitely care.
People care, but in practice, like, users are willing to use the system, even though the foundation itself like controls, you know, the vast supermajority of stake, or Noble is a POA chain. And so I think you're going to see a push more towards these POA type chains. I mean, like, this was the Celestia proposal that they had like a week or so ago. Like, what if we just like get rid of staking and just like, we just say like, hey, here are the validators and we pay them directly, instead of having this high inflation rate.
What was the response from the Celestia community?
It was like a mix of, I would say, people like me who have had a strong opinion on this for a while and like care about the economics of it, are like, yeah, this just like makes sense for what you're optimizing for.
Yeah.
And then a bunch of crypto Twitter. I I think that people genuinely like just don't understand the economics of proof of stake to like a meaningful extent.
Yeah.
I think there's a lot of people that still just have this old school ideology that like for some reason is valuable for you to put your money in a box and like print more tokens, and then therefore you get more money, and that's utility.
All right,
people like think that is like utility for the token, but like it's
in that clip that people were roasting me for, although people thought I was saying like proof of stake is cooked and we should move away from proof of stake, what I said was that I think the inflation rate should be much lower, but probably not zero. Right? They should be like some nominal amount of inflation to just like make sure people aren't like, if it's literally zero, then okay, you're just like paying people out of band and whatever. I am very sympathetic to the people who are like, no, we shouldn't like totally rip off the band or like just take off the face mask and be like, no, it's all proof of authority. And basically it's like these 12 guys are running the blockchain. And why do I feel that very intuitively, and I want to try to justify the intuition. And I hope it's not just that like I'm a hipster with respect to protocols, but I think it might be a little bit of that. I think in a way it almost seems analogous to me, like, okay, we all know, if you've been in the world for long enough, that democracy is a little bit of an ideal, but it doesn't really describe reality that well. The reality is that money talks, and the reality is that, moneyed interests, lobbying groups, people who can actually get organized and send their message out, they have a disproportionate voice in any democracy anywhere, right? And so you might say like, well, why do we even have this fig leaf of a democracy? Why don't we just directly use money-weighted voting, and like we can skip a lot of these steps and actually we get the same efficient outcomes, and you can argue that money is aligned with most people because of GDP and blah, 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 blah. And I'm like, yeah, maybe, but like I kind of feel like you're losing something almost like spiritually about the system if you completely remove the deference to the ideal.
So I think there's two parts to it. One is I don't think that most of these major chains like should get rid of proof of stake. I just, which is something that like I tried to put in the
Why not?
So for at minimum, it's if you don't want to have an opinionated governance model, like you just need some market mechanism to go pick all the stakers. Like Ethereum is not going to have this mechanism where we just like revisit the governance every few months and we're like, hey, who do we think all the validators should be? And then we pick 20 of them. That's just not how Ethereum works. You need to have some sort of market mechanism, just go pick them. I think that there is a spectrum, though, where there are a lot more, if, we call that like all the way on the right side, and then there's all the way on the left side. I think there are more chains that are over here that are like doing this thing and they don't need to be. For a chain like Hyperliquid, do we think that there would be any meaningful difference if the chain's governance just sort of picked like, hey, here are the 16 validators that we want, and you have equal stake? I would argue that would actually just be a better distribution because you would actually just have like equivalent stake throughout them. And I think it's the anti-democracy point to a meaningful extent there, of like the point was like for democracy, like why don't we just rip off the Band-Aid? It's money weighted, whatever. Proof of stake is the dollar weighted one.
Yeah.
Versus
true.
This is in this kind of like this proposal. I mean, like for Celestia, the way it would work is like you're just using your off-chain social consensus governance of like, who do we think the 50 or 100 or whatever validators should be? And we just like give them equal stake.
Yeah.
As opposed to what do we see in practice is the vast majority of users, I don't actually care if the stake is decentralized, and I'm just going to pick Coinbase. And like we all just like give our money to Coinbase. We all just delegate to Coinbase, and like they end up with like a third of the stake. And then you end up with like 5 validators that usually have like 2/3 of the stake. So if you're on this like far end of the spectrum where, all right, we've got an opinionated governance anyway, we're going to have a pretty small validator set. Why don't we actually just like pick who they should be and then just give an equivalent kind of voting weight throughout them and then skip like most of this staking stuff?
Okay, let me give you another example that maybe tests this intuition. So very often when a DAO is being set up, right? And I know these are all dirty words now, but when a DAO is being set up, a team usually has 2 decisions they can go down. One thing they can go down is say, okay, the DAO doesn't have the tokens distributed. We can just like force through the initial governance and basically say like, okay, we're going to, rubber stamp this, rubber stamp that. We have these committees, we have this thing, we have that thing, we have these, fucking token emissions, blah, 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 right? The second path is we can have this package of like initial proposals, and we'll actually distribute the token, and we'll actually let the community vote on this initial set. And if they might rebel, right, the way that Arbitrum initially rebelled on the DAO votes, but you like, look, put it all out in the field, and like if the people come back at you, then you just have to negotiate with the people. And some projects do the former, but some projects do the latter, and they take a risk in doing so. And I think what do they get for that risk? The answer, I think, is legitimacy. And legitimacy is a very hard thing to quantify. It's a very hard thing to measure, but I think it is something that you do kind of get, even if like, look, this on-chain straw poll thing with like tokens and blah, blah, blah. Like, why don't we just, look, the team obviously makes the decisions. Like they're the ones who are writing the goddamn code. They decide who the fucking validators are. And if you said no, like, go fork this thing. but there you lose some legitimacy for it, and I don't quite know where it comes from or like how to quantify it. But that does feel true to me. Does that not resonate?
I think a meaningful amount of what makes it feel special today is just the obscurity of the process, where it just like feels like this decentralized process where like we're all, free market and like we're all picking all these validators, when in practice, I mean, it's just the token holders who are picking them. And like, it's, if you have a centralized amount of like token holders, they're just going to pick a pretty centralized stake.
Yeah.
I also don't think it has to be that different. I mean, like the simple way you could do this is you just have token holders vote on like who they're going to be, as opposed to everyone just individually delegating to a staker and then having this inflation rate. So, I mean, like instead of every hype holder delegating, their stake to, I pick one of the 16 validators, because in practice, what do they pretty much all do is they just delegate them to the Hype Foundation. Because like, I don't even know who most of these other 12 validators are. I know who they are. I'm going to give them my money.
Yeah.
And then you end up with like super centralized stake. Versus what if you just like had all the token holders vote on, hey, who do we think should be the 12 validators? And they would just like equally distribute voting weight. And then we just skip the staking mechanism.
Yeah.
Because it basically comes down to that question of, do you think that you're getting this economic security from like locking your money in a box and delegating it to someone else? If you think the answer to that is no, you could probably just like go about this a different way. And like, it could just be token holder voting as opposed to locking their money in the box. Because if we basically just view economic security from this like locking the money in the box and staking to someone as not really adding value, and we view all of this extra inflation as just strictly tax inefficiency, why don't we just get rid of that and just pick who the validator should be, and then we send 100% of the staking rewards to them? What I think we're going to see in practice is what teams like Hyperliquid are doing, which is just push the bounds on proof of stake, which is to say just drop the inflation rate really, really low. Like they have, I think, like 1% or inflation or something like that. Like as a staker, you get, I think, like 2% yield ballpark. And so there's not a lot of incentive. And the result of that is, I don't know, maybe 30-40% of Hype is staked, something like that.
Right.
You don't get a lot of rewards. And so, I mean, you could just push it, you just push that to the limit. And the lower that you go, basically the higher percent of the rewards the operators themselves are going to take versus the stakers,
that seems right.
until you eventually push it all the way to the lower bound where the stakers are getting nothing and the operators are getting everything. And at the end of the day, what you have there is, I mean, the same thing. You just pick the validators and you give them the money for providing the surface.
Somehow that still feels better to me.
It does feel worse.
Yeah.
My guess is that we're just going to see this because I think that like we're going to just see more chains in the future that are just very explicitly corporate. Robinhood talked about decentralizing their validator already. Like that was the thing that they mentioned.
I didn't realize that.
Yeah, they talked about like, hey, we have an intention to like probably decentralize the sequencer later on. Someone like them particularly, do you think they're really going to care about this sort of just like, we're for the community and we want this like decentralized mechanism? Or do you think
why would they say they want to decentralize it?
Because I mean, one, maybe a regulatory arbitrage. It's like I
don't think Robinhood's doing regulatory arbitrages.
No, but it's very possible in the future that I mean, you could see a world where there's different treatment for, hey, are you running a centralized sequencer? Does this just look like a money transmitter?
I mean, this is certainly the hope of many people in crypto is that they will look closely at your sequencer and decide how decentralized it is to see whether you can just let anything happen on your chain. My guess is that's not how Robinhood and Coinbase will actually be treated.
But if chains like that are making chains in the future, do they need this like permissionless the community is deciding mechanism, or do you think it's probably okay if we're just like, hey, here are the 12 validators for the Robinhood chain, and like we trust them all? Like Robinhood runs one, and P2P runs one, and Figment runs one, and like we get it.
Yeah, Ryan, do you want to jump in?
So do you think it matters what the use case for a chain is, whether like proof of governance would work? I think, for example, you mentioned the Robinhood chain. I didn't know that they were going to decentralize the validator set, but that was the example I was going to give.
This was a thing that they like mentioned in the interviews. Right. It wasn't like we have a clear plan or how we're going to do this, but it was something that they explicitly mentioned.
Right, but like in theory, let's say that they're going to, I don't know, instead of one sequencer, there's now 10, and it's like a round robin, whatever the architecture is. Like maybe for that it makes sense because it's like, all right, what is the purpose of this chain? Like your point, it's really just for RWAs, and it's just like back-end infrastructure for Robinhood. So it doesn't need to have this, World War III resistance or this is not supposed to be a blockchain that is gonna store all the world's wealth, right? But I think maybe for that use case, does the proof of governance process start to undermine that property of a blockchain that it can become this world ledger? And like that's what I wonder with the proof of governance. And do you think it's like important for Ethereum to continue to?
Yeah, like I don't think Ethereum could do this. I think it just like it absolutely doesn't work. I just think that directionally we're moving more towards the world where more of these chains are going to be more corporate RWA looking.
Right.
And we don't need to have this hangover of like, hey, Circle's making a chain. Do we need to apply the same principles of, we want this like permissionless economic security thing? Or like, it's totally fine that Noble's a POA chain because like nobody cares.
I see.
And I think that's like clearly where we're heading. And I think people are just starting to realize that as we get more and more chains. Because Ethereum literally can't do this. It wouldn't make sense. But if you're just this chain, like we're an RWA chain, this is a pretty corporate thing, we could just say who the validators are. Like we're not trying to be this decentralized neutral world ledger. Like we could just pick who the validators are. Like we know the good operators. You're going to run a validator and like we're going to pay you 100K a year or whatever. And like it's cool.
I see. I think like usually we find, I think so many people come to crypto with like this very binary view of decentralization or centralization. And often cases when we find new products that people like, it's when we explore this spectrum, like in between. So for example, like Ethereum, like what was like the core belief that everyone had is that you need to run a validator at home. And then Solana is like, all right, no, you don't really need to do that. We can actually just run them in data centers and, maybe get more performance. You can design the system a different way. And then we get like a more performant system and we get new use cases unlocked. And then Hyperliquid comes along and is like, you know what, maybe we actually don't need to have globally distributed consensus. We can just have it all running in a data center in Tokyo. And for that, you get like way more performance, you get lower latency. And then for all of a sudden you can build like a on-chain, cloud, right? And maybe it's the same thing here where what we're figuring out is that, okay, you know what, this whole consensus process as well, like this process of choosing validators to participate in consensus, there's also room for experimentation there. And we might find that, you know what, when we do sacrifice a little bit on this ideal of having this totally permissionless process for joining a validator set, maybe we find out that, you know what, that actually isn't worth it in many cases. And that's fine because we actually get good products because of it.
Okay, well, I want to push back against that story because you're framing it as a like, okay, we're experimenting and doing things that we maybe were previously verboten or that we weren't doing. And my claim was that there were people who were saying like, oh, why don't we just run all the things out of a single data center? And we knew that we could. Everyone knew that. Of course, you can run a thing out of a data center, but you would have been laughed out of the room in 2020 of like, yeah, you shouldn't do that. That's like, really, what if the data center shuts you down because you're running an exchange and they don't like that, or the data center goes offline and then now, okay, the whole thing is offline, which of course happens to data centers. They have outages. And so I think a different way of understanding this is not that like, okay, we're stuck in our ways and now we're like experimenting, but rather there's been enormous erosion that has taken place within crypto. And maybe that's good from a UX perspective, because obviously the UXs of like, you think of like Augur, like in 2017 was just an absolute abomination of a UX, but it was this pristine, it didn't have to be that bad. It just happened to be really terrible. But like, it was the pristine embodiment of like, this is what it would look like if you're a decentralization maxi. And people just chewed the glass back then. And they were like, look, yeah, but you have to do it this way. You can't just do it all in one data center. And now people are saying like, oh, we're just doing a data center, and like, people who trade perps, they don't care, and that's fine. But I think it does seem like the answer is that the norms in crypto are changing, not that we've discovered something that we didn't know before. You know what I mean?
I think yes, but maybe like the nuance I'll add, like in like the Hyperliquid example, where you're right, like. Early on, there was all these I remember like in 2016, I went to Consensus, and the craze was about these consortium blockchains like R3, and
yeah.
I thought it was just super boring, and I don't know, maybe that's why I didn't actually get in 2016. I got in like 2017 because it didn't make sense to me.
Totally.
But I think maybe like the nuance that we're doing is your point. We're just pushing against these boundaries that we imagined, and we're finding out
ICP
that
did this, right? Wasn't ICP all in one data center, and people dunked so ferociously on ICP of like, this is like a boomer idea that you do the whole thing in one data center.
And I think rightfully so, but I do wonder if the product
why rightfully so?
Actually, rightfully so, maybe the wrong word, but I think the point with ICP is that the product wasn't good. So it's like, all right, you're doing this and you're claiming to be similar to Ethereum, but this is not actually but the product is not good.
Yeah.
The difference with Hyperliquid now is like, all right, we go and do local consensus in this data center, and the product is great. And then, you know what? Maybe people think about it. It's like, all right, I really like using this product. And when I really think about it, how risky is it to have this all running in a data center? Like, practically speaking, if there's an earthquake or a typhoon and it takes down this data center, right? What actually happens? You just move the server somewhere else, right?
Yeah.
It would be disruptive, of course, but it's not like the end of the world. Same thing with like, if the Hyperliquid bridge would be hacked. It's like, yeah, you know what, that would suck, but Circle would just press pause and then people would get their money back. So when you start to think about this more practically and not in just theoretical sense of this needs to be resistant to authoritarian governments taking over the world and all this, then maybe what people are realizing is that, okay, it was good to actually push up against these boundaries. And the result is we get a product that couldn't previously exist if we were to restrict ourselves to those norms we once had.
feels a little bit to me like the HR guy meme, you know, of like ICP comes in and is like, hey guys, I want to run a data center. It's like, your product is terrible. Go fuck off. And it's like, Hyperliquid, good product. Yeah, go ahead. One data center.
Yeah.
But I think your point is well made, is that like, hey, the risks are actually quite different if you look at the microstructure of what are the actual risks and how do they apply to a user of this platform that maybe are quite different if you're a general purpose layer one, although Hyper EVM is trying to be a general purpose layer one under the same architecture. So it's, you know, whatever, complicated. One other story that I wanted to get to before we wrap is there was an announcement, speaking of centralization and norm erosion, about a prediction market called Kalshi. So there are two big prediction markets, Polymarket, in which we are investors, and Kalshi. And Kalshi, they recently announced that they closed a funding round led by Paradigm. They raised 100-something million at a $2 billion valuation. So Kalshi is not a crypto prediction market, although they do accept USDC, but they're regulated in the US, and they're, I believe, the only CFTC licensed, or no, there's maybe
There's
one
also
other?
ForecastX,
There's
which is
ForecastX.
actually what Robinhood used for the election.
Also, I believe Railbird as well.
Yeah, yeah.
Out of CFTC.
Okay. So there are a few that are US licensed, but Polymarket right now is the biggest. But Kalshi is the second largest, and they're, you know, obviously very significant, backed by originally by Sequoia. And so I think the main part of the story is that when the launch announcement came out last week, you had a very striking tweet that sent the internet ablaze. You want to relay what your tweet was?
Oh, I was just reposting this Pirate Wire story from November or December, I guess, where Kalshi paid some influencers to repost this story about Shane Copland, the Polymarket founder, getting raided by the API, which is all fine. But, you know, I think it was just like a very bad look that they did this and then tried to be very coy about it. And I think a lot of people try to explain this away and say, oh, this is like friendly competition. And I'm like, I don't think this is friendly competition.
Okay, so your line was never forget, this is a team of little rats.
To be fair, this is one story. This is the public story of Kalshi. There's many other examples, which I'm not going to
Okay, well, so after you tweeted that, I actually was at a dinner with the Kalshi founder, and everybody... I didn't, because I was busy. It was the middle of permissionless, so I was just like running around, whatever. And then I show up to this dinner, and the Kalshi founder is there, like sitting across the table from me. And I'm like, "Oh, hi, I'm Haseeb from Dragonfly." And he's like, "Dragonfly, like Tom Schmidt, Dragonfly?" And I'm like, "I'm not Tom Schmidt. I'm Haseeb." And he's like, "Yeah, do you not see the tweet that went viral today?" I was like, "No, I have no idea. What tweet are you talking about?" And so this tweet was like fucking making its way around the world at the time I was at this dinner. And everybody was like, "Why are you even here? You should leave." So I got he was a nice guy though. He was gracious about it. Although he was a little upset that this tweet was going viral.
Yeah.
But I got some other Polymarket investors, Kalshi investors reaching out to me who were like, "Are you guys going to keep doing this of like going after Kalshi?" And I was like, "Look, I didn't do it. This is Tom.
Yeah.
I was people were sort of asking me in light of this, and I want to also get your guys' take since you're also investors. Although do you venture or just liquids?
Oh, just liquids.
Just liquids. Okay, but you're obviously a venture investor. Of like how what is your philosophy about fighting the fight for your portco? Like what I told people, because I'm like, look, I don't control Tom. Tom is his own man. It's his deal, and love makes you do crazy things. So I love Shane. I think he's great, but I'm like more of a neutral guy. I'm like, look, let the best prediction market win. But like, how do you feel about that kind, like getting involved on behalf of your portcos in like public fights?
So for anyone who follows me on Twitter, it's probably not going to surprise them that I have no problem being like a little bit edgy and like pushing the bounds on Twitter.
Okay, so you jump in the ring.
Yeah. So I like hats off. I'm good with it. Like,
okay, you're down with that. You think like that was totally the right move.
Yeah. I mean, like you guys are investors in Polymarket. What he said was true. It's like, all right, it's all fair game.
Okay.
Yeah. Clearly it resonated. You know, it's not. The likes didn't come from nowhere.
Yeah. No. I mean, I try to be more diplomatic because I'm just like, look, there's always shit going both ways, and it just like makes, I don't know. It's like I like sleeping soundly at night, but like
I sleep very soundly at night.
Do you?
Yeah.
Okay, damn. Ryan, do you have a take?
Yeah, I mean, it's a little bit different for me in public markets. I mean, like for us, I don't have to hold any positions that I don't want to, and I think by doing that, I'm not only actively not actively every day choosing to hold this asset, but also actively choosing to not be in other assets. So all to say, it's like on one hand, I can be extremely long term and hold an asset for as long as the fund exists, but I also have no loyalty because the second something changes, I can just sell it, right?
Hmm.
So maybe all to say is that it enables you to speak freely on whatever the topic is, because if something goes awry in a project that you were in, then you can just sell it and I don't know, say what you think, right?
Okay. Well, any positions that you are temporarily holding that you want to show before you dump them?
Temporarily holding. I'm holding everything forever. Everything in my portfolio.
Everything forever. Wait,
Oh, yeah.
I thought you just said that you were you're not married to anything.
Yeah, we'll see.
Do you have any forever positions?
You know, this is a good question, because one thing that I've been reflecting on the past 3 years, I guess, since we started the Syncrasy.
Oh, okay. We started recording this.
Is like how many assets has this industry created that you could actually hold for like even just 3 to 5 years, like confidently, you put your money in this, you don't look at prices for 5 years, you go into a coma and you wake up and you're totally fine, like you just sleep well at night. And for that, I'm actually not sure how many there are at this point. Like you maybe say like Bitcoin, Ethereum, maybe Solana, maybe, and after that there's just a very steep drop off where this asset class changes so much.
A lot of people who did that with Ethereum did not have a good waking up.
Yeah, I mean, that's the thing. It's like, Ethereum was the consensus best asset to own in 2022. I remember when we started Syncrasy, this was what everyone wanted to own.
Yeah.
ETH was going to change the world. Like DeFi was the greatest thing. NFTs were like this way of onboarding all these consumers on the blockchains. And then you think about today and no one cares about the metaverse. NFTs are dead. Ethereum has dramatically underperformed. And, like what actually was the one asset you could have held with confidence from with the same thesis from that period and actually made money? It's just Bitcoin. I mean, even Solana hasn't made new highs since the 2021 period.
Yeah.
So yeah, all to say, I'm not actually, I mean, I joke that I'm willing to hold these things forever, but I'm not married to any of these things right now.
Fair enough.
It's like, being poly. It's like not having a legally binding contract makes the love stronger,
Okay.
Every day you're waking up and you're choosing this asset.
Every day you wake up and you choose a new portfolio.
Yeah, so that's my investors.
That's really beautiful. All right. Where can people find you guys?
You can find us on syncrasy.io or follow me on Twitter at @RyanWatkins_.
You can copy trade whatever he's holding at the moment until he dumps on you. And where can people find you?
dba.xyz for a website, and John Sharp on Twitter.
Excellent. All right. That's it for this week. Thanks, everybody. See y'all next time.